Every miracle story has a dark footnote. For a decade, the Asian tigers were the poster children of globalization. Thailand, Indonesia, Malaysia, South Korea, the Philippines, economies sprinting ahead with 8 to 12% growth a year. New factories, new highways, new skyscrapers. Exports were booming, poverty was falling, and the world's financial press celebrated an Asian economic miracle. Investors from New York, London, Tokyo, Frankfurt looked at the charts and saw one thing: endless opportunity. Billions of dollars of foreign capital poured into Southeast and East Asia, chasing high returns in stocks, bonds, property, and bank loans. Money came in so fast it almost looked like the laws of gravity had been suspended. And then, almost overnight, the miracle turned into a trap. Currencies collapsed. Stock markets were slashed in half. Companies that had looked invincible on paper went bankrupt. Millions of ordinary people saw jobs disappear and savings disintegrate. Governments fell. What had been sold as a model of modern success revealed itself as something much more fragile, because so much of it had been built on one kind of money most people had never heard of: hot money. Hot money is not patient capital. It's not the kind of investment that builds factories and stays for decades. Hot money is nervous, speculative, and easily bored. It rushes in when the party starts, and it sprints for the door at the first sign of smoke. That is the heart of the 1997 Asian financial crisis. Not just that money left, but that entire economies had been designed as if it never would. To understand how the trap was set, you have to start with the seduction. In the 1980s and early 1990s, much of East and Southeast Asia was posting growth numbers that made developed countries look sluggish. Thailand OR's economy grew at an average of more than 9% per year from the mid-80s to the mid-90s. With low inflation and a currency, the baht pegged at roughly 25 to the US dollar. South Korea, Malaysia, Indonesia, and others joined in that high-growth club. It looked like a new model for development had been discovered. But behind the productivity, the exports, and the sweat, there was a second fuel: foreign capital. Policymakers in many of these countries made a deliberate choice. To attract overseas money, they kept their currencies either pegged to the dollar or tightly managed, signaling stability. They kept interest rates high relative to the US and Japan, making deposits and local bonds very attractive to foreign investors who were tired of low yields at home. Reforms and deregulation opened the doors wider to foreign banks and portfolio investors. Asia offered fast growth, high yields, and seemingly stable exchange rates. For international capital, it looked like a cheat code. The result was predictable. Huge volumes of foreign money flooded in, not just as long-term investment, but in short-term loans, speculative positions, and portfolio inflows that could, in theory, leave as fast as they arrived. Until 1997, almost half of all capital flowing into developing countries was going into Asia. On the surface, it was a dream. Currencies looked stable. Asset prices rose. Construction cranes covered skylines in Bangkok, Jakarta, Kuala Lumpur, and Seoul. Local banks and corporations borrowed heavily in foreign currencies, especially dollars, because dollar loans were cheaper, and everyone assumed the exchange rates would remain predictable. As long as the peg held, borrowing in dollars and earning in local currency seemed like free money. That is where the trap began. Hot money is like a guest who promises to stay for the whole party but keeps one hand on the door handle. It's not attached to a country's long-term success. It's attached to short-term returns and perceived safety. It flows in because interest rates are high, the currency looks strong, and everyone else is piling in, but it has no loyalty. Thailand is where the illusion snapped first. By the mid-1990s, Thailand was the poster child of the miracle. High growth, impressive infrastructure projects, a booming property market, and a baht fixed in value. Underneath, though, pressure was building. The country ran large current account deficits. It was importing more than it exported, and the gap was being filled by foreign borrowing. Real estate speculation had created a bubble. Banks and corporations had stacked up large amounts of short-term foreign currency debt. Speculators, analysts, and some policymakers started asking a simple question: could Thailand really maintain its currency peg and keep rolling over all that foreign debt? If the answer was no, then betting against the baht was easy money. In May 1997, the baht came under heavy speculative attack. The central bank burned through foreign reserves trying to defend the peg. On July 2, 2097, the government finally surrendered, abandoning the fixed exchange rate and allowing the baht to float. The currency immediately plunged in value and would end up losing more than half its worth by the end of the year. For Thai borrowers, who owed money in dollars, this was catastrophic. If a company owed $1 million and the baht suddenly bought half as many dollars as before, the real burden of that debt in local terms doubled. On balance sheets, companies that had seemed profitable were suddenly insolvent. Banks that had seemed solid discovered that a huge share of their loans could never be repaid. And the investors who had rushed in, praising Thailand's fundamentals, began to rush out. Crises rarely stay contained. Once markets saw Thailand fall, they started looking around the neighborhood. Who else had a fixed or semi-fixed exchange rate, large foreign currency debts, big current account deficits, and banking systems exposed to property bubbles and politically connected borrowers? The answer, quite a few. The Philippine peso, the Malaysian ringgit, and the Indonesian rupiah came under speculative pressure next. Central banks tried to defend their currencies with higher interest rates and interventions, but their foreign reserves were limited. Capital, on the other hand, could leave at almost infinite speed. Soon, the crisis reached South Korea, a more industrialized economy dominated by huge conglomerates, the chaebol, which had also been borrowing aggressively from abroad. As confidence evaporated, the won weakened sharply, and Korea faced a brutal liquidity crunch. The numbers tell the story of panic. Between mid-1997 and mid-1998, the Thai baht, Indonesian rupiah, Malaysian ringgit, Philippine peso, and South Korean won all suffered staggering devaluations, in some cases losing more than half their value against the dollar. Stock markets collapsed. Domestic interest rates were pushed sky high in desperate attempts to lure capital back and defend currencies, making it even harder for businesses to survive. Behind those numbers were people. Workers laid off as construction projects froze. Families watching food and fuel prices surge because their weak currencies made imports more expensive. Middle-class savers who discovered their banks were insolvent and their deposits frozen. In Indonesia, the economic shock fed into political unrest that helped bring down President Suharto after more than 3 decades in power. When a crisis like this hits, someone has to decide who gets rescued, who takes losses, and what conditions come attached to the lifeline. In the Asian crisis, that someone was largely the International Monetary Fund and other international lenders. The IMF assembled massive rescue packages for Thailand, Indonesia, and South Korea, tens of billions of dollars in pledged support. The goal, officially, was to stabilize currencies, restore confidence, and help these countries roll over their debts instead of defaulting. But the money came with strict conditions. Governments were told to cut spending, even as economies were contracting. Interest rates were kept high to support exchange rates. Banks were closed or merged, and financial sectors were restructured. Markets were opened further to foreign ownership and competition. The argument was that these tough measures would clean up corruption and inefficiency, modernize financial systems, and set the stage for long-term recovery. To critics, especially within the affected countries, it looked different. They saw local banks being shut down, domestic companies failing, and valuable assets being sold off at crisis-level prices to foreign investors. They saw ordinary citizens bearing the pain through unemployment, austerity, and inflation, while many international creditors were ultimately repaid, often using IMF-backed public funds. Losses, once again, were socialized. The hot money trap doesn't work because hot money exists. It works because systems are built on the assumption that hot money will always be there. Before the crisis, the model looked like this. Attract foreign capital with high interest rates, stable exchange rates, and impressive growth numbers. Let local banks and corporations borrow abroad cheaply, pour the money into property stocks and ambitious projects, and trust that as long as the music doesn't stop, everything can be rolled over indefinitely. What actually happens is more dangerous. First comes the attraction. High yields and seemingly low-risk lure in global investors. Countries are praised for reforms and openness. Capital flows far faster than it can be productively absorbed. Then comes leverage. Local borrowers stack up foreign currency debt, often short-term. Banks expand credit rapidly, confident that they can always roll their external funding. Asset prices are pushed higher by this flood of money, which in turn justifies more borrowing. Imbalances build quietly. Current account deficits widen. Debt levels rise. The system becomes dependent on constant new inflows to pay off yesterday's obligations. Any slowdown in capital inflows starts to expose weak borrowers and bad investments. At some point, there's a shock. It might be a rise in U.S. interest rates that makes emerging markets less attractive. It might be a slowdown in exports. It might be a speculative attack that tests a currency peg. Whatever the trigger, confidence wavers. Once investors start heading for the exits, the model turns from a virtuous cycle to vicious spiral. Selling the local currency pushes it down in value. A weaker currency makes foreign currency debts harder to repay. That increases default risk, which triggers even more selling. Central banks raise interest rates to defend the currency, but high rates damage the real economy. Reserves bleed away. Eventually, the peg snaps, and the full weight of the devaluation hits balance sheets. From the outside, this looks like a sudden collapse. From the inside, it is the logical result of years of building a system on short-term foreign money. It would be comforting to blame everything on foreign speculators, hedge funds, and nameless markets. They played their part. But the crisis was also a story of domestic choices. In many of the affected countries, rapid growth sat on top of weak institutions. Loans were frequently directed to politically connected corporations rather than to the most productive projects. Crony capitalism, became a popular phrase. An economy where access to credit and contracts depended more on relationships than on sound business plans. Corporate governance was often poor. Debt levels were too high. Transparency was limited. Hot money did not create these vulnerabilities. It amplified them. Easy foreign credit makes bad decisions look good for a while. Rising property values make every project seem profitable. As long as money is cheap and plentiful, structural weaknesses can be hidden. When the tide of liquidity goes out, they are exposed all at once. Despite the devastation, the Asian financial crisis did not permanently derail the region. By the early 2000s, many of the same countries that had been on the brink were growing again, but they came back with new scars and new rules. One lesson was simple and blunt. Never again be caught with tiny foreign exchange reserves and massive short-term foreign debts. Asian governments began accumulating large reserves of dollars and other hard currencies, building financial buffers so they wouldn't have to turn to the IMF so easily next time. Another lesson: hard pegs to the dollar were risky. Many countries shifted toward more flexible exchange rate regimes, allowing their currencies to move instead of defending fixed levels at all costs. Banking systems were restructured, at least partly cleaned up, and subject to stricter oversight. In Malaysia, capital controls were imposed at the height of the crisis to stem outflows, moves that were condemned by many at the time, but later seen by some as having softened the blow and allowed a faster recovery. Asia adapted, but the pattern did not disappear from the world. The same hot money logic has surfaced again and again. In Mexico in 1994, in Russia's default in 1998, in Argentina's crises, and in the sudden stops that hit various emerging markets whenever global investors change their minds. Changes in U.S. monetary policy, especially hints that interest rates will rise, have triggered waves of capital outflows from countries that had come to depend on cheap external credit. Different names, different headlines, same vulnerability. When your growth model depends on money that can vanish overnight, it isn't really your growth. It's rented. For people living inside these systems, that distinction matters. Ordinary citizens earn wages in local currency, buy food in local markets, pay rent, and save in local banks. Their economic reality is slow and physical, but their fate can be tied to decisions made in faraway central banks, to portfolio reallocations by fund managers they will never meet, to speculative attacks they hear about only after their currency has already fallen. The Asian financial crisis was a brutal reminder that the gap between local life and global capital can close very fast. The lesson is not that all foreign capital is bad. Long-term investment that builds real capacity, factories, skills, infrastructure, can help a country grow. The lesson is that relying on short-term foreign money to cover structural weaknesses is dangerous. It creates the illusion of stability while storing up explosive fuel. Hot money loves a miracle. It loves the story of a region that has finally cracked the code. High growth, rising markets, stable currencies. It rushes in for the good times. But when confidence breaks, hot money does not stay to help rebuild schools, recapitalize banks, or support unemployed workers. It runs. In 1997, that is exactly what happened. The miracle decade turned into a fire sale. The same flows of capital that had been praised as a sign of global integration suddenly looked like a transmission line for panic. The countries hit hardest by the crisis did eventually recover. Some emerged more cautious, more resilient, more skeptical of easy money and unqualified praise from international institutions. But the structure of the trap, short-term foreign money funding long-term illusions, remains available to anyone willing to step into it. So whenever a new tiger, miracle, or economic superstar is celebrated in headlines for attracting record foreign inflows, it is worth pausing and asking a few quiet questions. Where is the money coming from? How quickly can it leave? How much of it is building something real and how much of it is just inflating prices? And if sentiment turns, who will be left holding the promises? And who will be holding something real? History does not repeat with the same currencies or the same acronyms, but it does repeat in patterns. The 1997 Asian financial crisis was one of the clearest demonstrations of the hot money trap the world has ever seen. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.